Welcome to the Radio Revenue Podcast.
It is really great to be here.
Today, we are looking at a name that honestly feels like it has been woven into the fabric of American industry forever.
Oh, yeah, absolutely.
I mean, we are talking about DuPont.
DuPont, right.
But listen, if you are sitting there picturing black and white photos of gunpowder mills or even the nylon revolution of the 20th century, you need to wipe that slate clean right now.
Totally clean.
We are doing a deep dive into their 2025 annual report. That is the Form 10-K, which was just revealed to the public right before our late February 2026 recording date here.
Yeah, and let me tell you, this is absolutely not your grandfather's DuPont.
No, it is not.
It's not even your father's DuPont. When you open up these financials from 2025, you aren't looking at some static industrial giant anymore.
What are you looking at then?
You're basically looking at a chrysalis.
A chrysalis. Okay. That is a very poetic way to describe a 10-K filing filled with balance sheets and risk factors.
I know, but it fits perfectly. I mean, you are seeing a creature right in the middle of a total biological metamorphosis.
Right.
The company has fundamentally changed its shape.
Yeah.
The biggest headline here isn't really just what they earned, it is what is gone.
Yeah, because looking at this report, the very first thing that hits you is the absences.
Exactly.
The DuPont everyone thought they knew has slimmed down dramatically. As of November 1st, 2025, the electronics business is just gone. And that was a massive part of their identity.
A huge part. But it is now a completely separate company called Cunity.
And that is not the only exit.
You also have the Aramids business.
Right, Aramids.
For you listening, that is the division behind the famous bullet-resistant material.
Yeah.
Kevlar.
Right, exactly.
And that entire business is currently sitting on the books, listed as held for sale.
Held for sale.
Yeah, they actually expect that deal to close in the first quarter of 2026.
So our mission for this deep dive is to figure out what is actually left. We aren't just going to rattle off revenue numbers today. We are tracking a transformational journey.
Which is fascinating.
It is. We need to uncover how this legacy chemical giant has essentially carved itself down into two very specific pillars.
Those being healthcare and water.
Yep, healthcare and water, and then the second one is diversified industrials.
It really is a strategy of subtraction to create value.
Subtraction, right.
But as we will see in the documents today, subtraction comes with some pretty heavy costs.
Oh, absolutely.
And some very interesting accounting maneuvers that we need to decode for you.
Okay, well, let's unpack this great separation. I want to start with Cunity because this wasn't just some small divestiture where they sold off a single factory in the suburbs. This was a massive chunk of the company's internal organs.
It really was. In the documents, they officially called this the electronics separation.
Right.
On November 1st, 2025, DuPont distributed all the Cunity stock to its existing shareholders.
Just handed it out.
Exactly. So if you woke up that morning owning DuPont stock, you suddenly own Cunity too.
Okay, but here is the detail that really matters for the DuPont balance sheet.
The cash.
Yes, and it is one that often gets missed in the headlines. Cunity didn't just walk out the door empty-handed.
Or rather, they didn't leave DuPont empty-handed.
Right, I saw this in the cash flow statement. It looks like a parting gift. Before Cunity left, they cut a massive check back to the parent company.
They did indeed. Cunity paid DuPont a cash distribution of approximately $4.1 billion.
$4 billion.
Yep.
That is just a staggering amount of cash.
It really is.
It's like a teenager moving out of the house but leaving a briefcase full of money on the kitchen table for their parents and saying, here, go pay off the mortgage.
That is actually a surprisingly accurate analogy. In corporate finance terms, it is technically a dividend.
Right.
DuPont essentially extracted the value from that electronics business one last time right before spinning it off.
So what did DuPont do with that mountain of cash? Did they go on a spending spree, buy new corporate jets, a Super Bowl ad?
Quite the opposite, actually. They did the responsible, arguably boring but highly strategic thing.
They paid down debt.
They used that cash to pay down about $4 billion in debt.
Wow.
Specifically, they redeemed notes that were due in 2028, 2038, and 2048.
So this was just a massive deleveraging event.
Precisely. I mean, think about the interest rate environment we've been living in.
Right. Carrying debt is expensive.
Very expensive. By using the Cunity cash to wipe out $4 billion in debt, they didn't just shed a business line. They shed the financial anchor associated with carrying that old conglomerate structure.
Which makes the remaining company much lighter on its feet.
Yes, and it drastically frees up cash flow for the future.
Okay, so Cunity is the clean break. That makes sense. But then we have the other exit.
The Aramids business.
Right, the stuff that stops bullets. It feels like this incredible defensive moat you would really want to keep in your portfolio. Why sell it?
Well, it is being sold to a company called Arklin, which is a portfolio company of TJC LP.
Okay.
And the logic here is usually that it just doesn't fit the new high-growth narrative anymore.
Oh, I see.
DuPont wants to be all about clean water and life-saving healthcare.
Right.
Making industrial fibers, even famous ones like Kevlar, is just a totally different business model with very different margins.
But there is a number in this 10K regarding Aramids that literally stops you in your tracks.
I think I know exactly what you are looking at.
Is it the ouch moment in the income statement?
It is definitely an ouch moment. In the first quarter of 2025, DuPont took a goodwill impairment charge of $768 million related to Aramids.
Whoa. Okay, let's pause and translate that for you listening. We hear goodwill impairment a lot in the financial news. What does that actually mean in plain English?
In plain English, it means we were wrong.
Wow.
Yeah, when a company lists goodwill on its balance sheet, it represents the premium value of a brand or business unit beyond its physical assets.
Like the reputation or the customer list?
Exactly the magic. So an impairment charge is the company officially admitting, we thought this business was worth X, but actually, upon review, it is worth a lot less.
So they basically vaporized value.
On paper, yes. The carrying amount of the Aramids unit on their books simply exceeded its fair value.
Right.
So before they could even sell it to Arklin, they had to publicly acknowledge that nearly $750 million in perceived value just evaporated.
That is a painful realization of value loss right before the sale.
It really is.
That stings. It's like listing your house for $1 million and the inspector comes in and says, well, actually, the foundation is cracked, so it is only worth $700,000.
Exactly.
Yeah.
And you have to swallow that loss publicly. It is the cost of clarity, really.
The cost of clarity.
When you decide to focus your company, you have to be honest about the actual value of what you were getting rid of.
Okay, so once the dust settles, quality's gone, debt is paid down, Aramids is heading out the door. What is DuPont now?
The two pillars.
Right, you mentioned two pillars earlier. Let's talk about the first one, which definitely seems to be the new star child of the portfolio.
Healthcare and water technologies.
Yes.
This is clearly where they want the market to look. This is the sexy part of the business now.
The numbers look good.
Very good. For 2025, this segment pulled in net sales of $3.2 billion.
Okay.
And the profitability is really strong. Operating EBITDA was $972 million.
Wow.
Which is up 15% year over year.
Okay, just for clarity for everyone listening, operating EBITDA is basically their cash profit from operations, right?
Correct.
Before the accountants and the tax man get involved.
Right. It stands for earnings before interest, taxes, depreciation, and amortization. It is a true measure of raw operational efficiency.
And nearly $1 billion in profit on $3.2 billion in sales is a very healthy margin.
Roughly 30%. That is exactly why investors love this sector.
And when we look at what they actually sell in this segment, it feels very modern.
Totally.
We aren't talking about vats of mystery sludge here.
Exactly.
We are talking medical packaging. That is the Tyvek brand again. Medical devices, biopharma to tubing.
And then the water side.
Right, the water filtration, reverse osmosis, ion exchange, resins like amberlight and film tech.
It's a super compelling narrative. I mean, if you are an investor, you look at the macro global trends.
Populations are aging.
Exactly.
Yeah.
So they need more healthcare. The world is getting thirstier.
We need cleaner water.
Right. DuPont has positioned this segment to just ride those two massive global waves.
It sounds perfect, but I hear a slight hesitation in your voice. You are looking at your notes for the downside, aren't you?
Well, you guys have to look at how they grew that EBITDA.
Okay.
The top line numbers look fantastic.
Yeah.
But if you actually dig into the volume metrics...
Meaning the physical amount of stuff they sold?
Exactly. The physical volume actually declined by 6%.
Wait, hold on. Sales dollars are up, profits are up, but they actually sold 6% less product.
Correct. They faced significant destocking in medical packaging in 2025. Yeah, that means their customers already had too much inventory sitting around in warehouses, so they just stopped buying new stuff.
Oh. Yeah.
And they also faced really weak industrial demand in China.
So how on earth do you post 15% profit growth if you are physically selling fewer widgets? Did they just jack up the prices?
Pricing was definitely a part of it, but the real story is that they bought their growth. The revenue increase came primarily from portfolio moves.
Acquisitions.
Right. They acquired a company called Spectrum Plastics Group in August 2023.
Okay.
And then another one called Donatel Plastics in July 2024.
I see. So the organic engine, the legacy business, was actually sputtering a bit,
Yes.
but they just bolted on a massive new engine to keep the car moving faster overall.
That is a very fair analogy. And look, M&A, mergers and acquisitions, is a perfectly valid growth strategy.
Sure.
Spectrum and Donatel are high-value medical part manufacturers. They make the specialized tubing and catheters used in complex surgeries.
Very high margin stuff.
Exactly. But you, as the listener, really need to understand that the base DuPont business wasn't exactly flying off the shelves in 2025.
Right.
They pivoted heavily to these new acquisitions to offset the softness in their core base business.
That is a crucial distinction. It's the difference between becoming a faster athlete versus just buying better running shoes.
Very true.
Okay, well, let's look at the second pillar then. Diversified Industrials. This one feels less like the star child and a bit more like the workhorse of the company.
It absolutely is the workhorse. This segment actually generated $3.6 billion in net sales for 2025.
So it is actually larger than the healthcare and water segment in terms of pure revenue.
It is.
Yeah.
But look at the EBITDA.
Okay.
It is $800 million.
Yeah.
And crucially, that number is down 5%.
So bigger sales than water, but less profit, and the profit is dropping.
Right.
What exactly is in this bucket?
Well, this is your construction materials.
Okay.
If you have ever seen a new house being built and it's wrapped in that white paper.
Oh, Tyvek house wrap. Yeah.
Exactly. It also includes styrofoam insulation and Corian surfaces for your kitchen countertops.
Oh, I know Corian.
But it also goes into high-tech industrial uses. Auto adhesives like Beta Seal and really advanced aerospace parts under the Vespel brand.
I see. So this entire segment is heavily tied to the macroeconomy.
Very much so.
When the housing market sneezes, this segment catches a cold.
Exactly. And the industrial market generally has been pretty tough lately.
Right.
Volume here was down as well. Now, they did see some growth in automotive and aerospace because people are buying cars and planes again.
Which helped.
It did help, but just not enough to completely offset the broader declines they saw in housing and construction.
So if I am a listener trying to visualize this new DuPont, it really is no longer a chemical vat company.
Not at all.
It is a company that wraps your house to keep it warm, filters your drinking water, and packages the actual tools the surgeon uses on your heart.
That is a very accurate picture.
Wow.
They market themselves now as an advanced solutions provider.
Advanced solution.
Yeah, they are intentionally moving away from commodity chemicals, the stuff you just buy by the ton.
Right.
And they are moving into highly engineered parts and materials that you buy because they perform a specific, very difficult task.
But changing your entire corporate identity like that isn't free.
Definitely not.
We talked about the impairment charge earlier, but there are other real-world costs to this transformation, right? You don't just wake up one day and say, we are a new company, without writing some massive checks.
Oh, absolutely. You don't split a huge company in half without breaking a few eggs.
And draining a few checking accounts.
Exactly. In March 2025, they officially approved what they call the Transformational Separation-Related Restructuring Program.
That is quite a mouthful of corporate jargon.
It really is. It is essentially corporate speak for layoffs, closing facilities, and asset write-downs.
And how much did that cost?
They have charged $69 million to this program so far.
Okay.
Mostly for severance payments to the employees who were let go during the restructuring. And that program actually runs through 2026, so the bill isn't even fully paid yet.
Wow. Still, despite all those costs and despite the volume declines we just talked about, the stock market seems to be absolutely loving this news story.
Oh, the market loves it.
I am looking at the stock performance chart right here in the report. DuPont closed 2025 at $168.51 per share.
Right, and you have to compare that to $127.85 the year prior.
That is a massive jump.
It is a significant jump. The market is completely buying the story that leaner is meaner.
And I'm sure the share buybacks didn't hurt that narrative either.
They never do.
Companies love to support their stock price by buying their own shares. I see they approved a $2 billion share repurchase authorization in November 2025.
And they did not waste any time using it either.
Yeah.
They executed a $500 million accelerated share repurchase, or ASR, right in the fourth quarter of 2025.
Okay, let's break that down for a second. What is an ASR? It sounds fast.
It is fast. Instead of buying shares gradually on the open market day by day, they basically go to an investment bank and say, here is $500 million. Give us the shares right now.
So the bank just fronts the shares?
Yes, the bank fronts the shares, and then the bank goes out and buys them back from the open market over time.
Got it.
In this specific case, DuPont retired 10.2 million shares immediately.
Wait, I saw the price point on that. It was about $39.15 per share.
Yeah.
Well, didn't you just say the stock closed at $168?
Right.
That math doesn't add up at all.
Good catch. The $39.15 figure you see in the table is likely a result of the historical adjustments related to the spin-off distribution of Cunity.
Oh, because they spun out so much value.
Exactly. When you spin off a huge chunk of value, the historical stock price of the parent company adjusts downwards on paper to reflect that the remaining business is fundamentally smaller.
Ah, okay, that makes sense.
The historical prices get restated. But honestly, the key takeaway here isn't the specific dollar amount per share in that table.
What is it then?
It is the aggression. They are aggressively reducing the overall share count.
Right. It's the classic pizza analogy.
The pizza analogy.
Yeah, if you cut a pizza into 8 slices instead of 12, each individual slice is just bigger.
Exactly. By reducing the total number of shares, the earnings per share, the EPS naturally goes up, even if the total net profit just stays flat.
And Wall Street loves rising EPS.
They adore it. It makes the company look more profitable on a per-share basis, even if the total pie isn't really growing as fast as we would like.
So they're shrinking the company operations, they're shrinking the debt, and they are shrinking the share count.
Yes.
It really is a massive less is more strategy.
It definitely is. But we have to talk about the one thing they haven't been able to fully shrink.
Oh, boy.
The ghost in the machine.
I know exactly where you're going with this. The liabilities.
Yep.
Specifically, the forever chemicals.
PFAS, per-am polyfluoroalkyl substances.
Right.
These are those chemicals that simply don't break down in the environment.
And DuPont, in its various historical forms, was a major producer of them.
Huge producer.
Yeah.
And even though the current version of DuPont split from Dow and Corteva years ago,
Right?
and even though they just spun off Cunity, the new DuPont still holds what they call stray liabilities.
Stray liabilities.
Yeah.
It sounds like a sad lost dog you find wandering in a parking lot.
Except this particular dog has a billion-dollar bite and a massive team of lawyers.
Fair point.
Because the DuPont entity has split and merged so many times over the decades, there are incredibly complex agreements about exactly who pays for the lawsuits stemming from 20 or 30 years ago.
Wow.
There's a detailed cost-sharing memorandum of understanding, an MOU, between DuPont Corteva and Chemours.
Okay.
They literally have escrow accounts funded specifically to manage this ongoing risk.
And we saw some really big numbers hitting the books in 2025 regarding this, didn't we?
We did. There was a proposed settlement with New Jersey, the NJ settlement. That alone led to a $186 million charge in 2025.
Ouch.
And do you remember the massive water district settlement that was finalized back in 2024?
Oh, right. I do remember that.
That was $1.185 billion split among the various parties.
Wow.
These are absolutely not rounding errors.
No, these are huge numbers that just completely drag on the bottom line. But here's where it gets really interesting.
Oh, yeah.
You found a tiny detail in the Cunity separation agreement that I completely missed the first time around.
I love this detail.
It's about how they actually handled these legacy liabilities during the spinoff.
This, for me, is the critical aha moment of the entire 10K report.
Let's hear it.
When companies spin off a shiny new division like Cunity, they usually try to make it look as clean and perfect as possible so the new stock pops on day one.
Right, they keep all the bad stuff at the old parent company.
Exactly.
Yeah.
But here, DuPont did something very different. In the separation agreement, Cunity, the brand new electronics company, actually agreed to take 44% of certain legacy liabilities.
44%.
Yes.
That is almost half.
Yep. And that includes the PFAS funding obligations.
Wow.
DuPont kept 56%.
Stop and think about that for just a second. DuPont didn't just spin off a business to unlock shareholder value.
No.
They spun off nearly half of their biggest legacy headache.
Precisely. If they had kept Cunity in-house as a division, DuPont would obviously still be on the hook for 100% of that liability.
Right.
By spinning it off, they essentially transferred 44% of that massive risk straight over to the new Cunity shareholders.
That seems incredibly savvy for the DuPont management team, but maybe a bit of a raw deal for the Cunity investors.
But look, Cunity investors got a very profitable high-tech electronics company out of the deal.
True.
But yes, they also inherited a mortgage on the past.
Yeah.
But for the remaining DuPont entity, the one we are analyzing today,
Right.
it is a massive strategic win. It cleans up the balance sheet in a way that merely paying down debt cannot do.
Because you are actively exporting your legal risk. That is truly fascinating. It is almost like getting a divorce and successfully convincing your ex-spouse to take 44% of the credit card debt you racked up 20 years ago.
That is a very apt, if maybe slightly cynical analogy.
Fair enough.
But honestly, in the corporate world, that is just a masterstroke of structuring.
It really is.
It shows that this management team is laser-focused on de-risking the entire future of the company.
Right.
It suggests they're trying desperately to isolate the healthy core of the current business from the toxic ghosts of the past.
Okay, so what does this all mean for you, the listener? Let's try to synthesize all of this because we have covered a ton of ground today.
A lot of ground.
Yeah.
But if we zoom out, we are essentially looking at a company that is rigorously disciplined.
Very disciplined.
In 2025, they executed a highly complex playbook perfectly.
They shed the electronics business.
Right.
They put Aramids up for sale.
Yep.
They took the massive cash dividend from the spinoff and immediately paid down $4 billion in debt.
And they are now laser-focused purely on water, healthcare, and housing.
It sounds like a company that finally knows exactly what it wants to be when it grows up.
It really does.
Mm.
They've cleaned up the corporate structure. They have reduced leverage across the board, and they have managed their legacy liabilities incredibly aggressively.
So they are leaner, lighter, and much more focused.
Exactly. They have essentially trimmed all the fat and, frankly, even some of the muscle to get to the exact fighting weight they want.
But I sense a final question coming from you. There is always a catch with these things.
There's always a catch. And the underlying question here is all about growth.
Growth, right.
We saw clearly that in their new core businesses, healthcare, water, industrials, actual physical volumes were down in 2025.
Right, they were selling less stuff.
Less stuff. They masked that physical decline by simply buying Spectrum and Donatel.
Right, and you can't just buy companies forever.
No, you really can.
Eventually you run out of cash or you just run out of good companies to buy.
Exactly. Eventually you have to sell more widgets yourself.
So what is the takeaway?
The provocative thought for the listener to take away today is this. Can this new, leaner, cleaner version of DuPont actually grow organically in 2026?
That is the big question.
Because now that the huge distractions of electronics and Aramids are completely gone, there are no more excuses.
Right.
The spotlight is fully on these two remaining pillars. If the housing market stays soft this year or if medical destocking continues, they won't have the grand transformation excuse to hide behind anymore.
That really is the defining question for 2026. Can the star child and the workhorse actually pull this massive cart forward on their own? Or is this just a shrinking empire disguised as a transforming one?
We will definitely have to watch the next 10K to find out.
We absolutely will.
But for now, you have to admit the transformation itself is undeniably impressive.
Oh, it is.
They have set the stage perfectly. Now they just have to perform.
Well, that brings us to the end of this deep dive into the 2025 DuPont annual report.
It has been a really fascinating look at corporate engineering at its finest.
Indeed, a complete masterclass in restructuring.
Absolutely.
It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.